You have been told your entire life that buying a home is the smartest financial move you will ever make. And the numbers say that is one of the most expensive beliefs a person can hold. Strip away the cultural mythology, strip away the political messaging, strip away the advertisements and the family pressure. And what you find underneath is that the average home appreciates at roughly the rate of inflation, meaning in real terms. After accounting for what money is actually worth, most homeowners build almost no wealth from the house itself. What they build is the appearance of wealth, a large number on a page that quietly shrinks every time you subtract what you actually spent to own the thing. In this video, we are going to go through the actual numbers, the actual costs, the liquidity trap, the mobility penalty, and the political economy of why the homeownership myth has been so aggressively promoted. And by the end, you will have a completely different framework for thinking about the biggest financial decision most people ever make. Let's start with the most basic comparison, because this is where the mythology falls apart fastest. From 1980 to the mid-2020, the cumulative appreciation of the median American home price was roughly 600%, which sounds extraordinary until you put it next to the alternative. Over that exact same period, the S&P 500 returned more than 20,000% on a reinvested dividends basis. That is not a small difference. That is not a rounding error. That is a gap so large that if you had taken the same money and put it in a basic index fund instead of a house, you would have ended up with roughly 33 times more return on your investment. The S&P 500's long-run return is approximately 10% per year nominally, and 7 to 8% per year in real, inflation-adjusted terms. Residential real estate across the same long periods generally appreciates at a rate that tracks general inflation, sometimes modestly beating it, sometimes falling slightly behind it, meaning in real terms, the typical homeowner captures close to zero actual return from the underlying asset. But that is only the beginning of the problem, because what most people track is the headline appreciation, what the house is worth versus what they paid for it, without subtracting what they spent to own it along the way. Maintenance and repair alone costs between 1 and 3% of the home's value every single year. And this is not optional spending. It is the unavoidable cost of keeping the asset from deteriorating. A home worth $400,000 costs between $4,000 and $12,000 per year, just in maintenance before you account for property taxes, homeowner's insurance, or the interest on your mortgage. Property taxes vary by region but represent a significant ongoing cost that never goes away, unlike rent, which can be raised but can also be escaped. Property taxes follow you as long as you own the asset. Insurance premiums have risen sharply in recent years across many regions, particularly in coastal areas, and a growing number of properties in high-risk zones are becoming effectively uninsurable. Meaning the asset you were told was a stable store of value is now carrying a risk that no private company will price anymore. A widely accepted rule among financial analysts is that between 30 and 50% of gross home appreciation is consumed by ownership costs across a typical 30-year hold, meaning even the headline appreciation number, which already underwhelms compared to equities, gets cut nearly in half before it reaches your actual net position. Then there is the mortgage itself. And this is where people get confused by the mathematics of leverage. Homes look like great investments partly because they are almost always bought on leverage. You put down 20% and control 100% of the asset. So if the home rises 4% in value, you are earning what looks like a 20% return on your deposit. But that calculation only works before you subtract the interest you paid to access that leverage. And in the early years of a standard 30-year mortgage, the vast majority of each monthly payment goes to interest rather than to paying down what you actually owe. A borrower typically pays off the first 5 percentage points of their loan principal in the first 5 years, and very little more beyond that. Meaning for years, Most of your payment is a fee to the bank, not equity you are building. And if you sell before you have held the home long enough to absorb the transaction costs of buying and selling, which combined typically run between 8 and 12% of the home's value, you walk away having lost money even if the house appreciated. The widely accepted break-even hold period, accounting for all transaction costs, is between 6 and 8 years, meaning if anything in your life changes before that window closes, you are likely leaving at a loss. Now here is the structural problem that the financial advice industry almost never discusses honestly. A house is not just a financial asset. It is a geographic anchor, and geography is one of the most powerful determinants of lifetime income. The regions of the United States with the strongest wage growth, the most new jobs, and the best long-term economic opportunity tend to have the highest home prices, meaning the people who can least afford to buy there are the ones most incentivized to stay there. And the regions where homes are most affordable tend to have the weakest wage growth and the fewest high-paying opportunities. A renter can move in 30 days to chase a better job, a better city, or a better wage. A homeowner has to sell first, which takes months, costs 8 to 12% of the home's value, and is nearly impossible if the market has softened. The Consumer Financial Protection Bureau has published research specifically quantifying how homeownership reduces labor mobility, the ability of workers to move to where the jobs are, with measurable consequences for wages, productivity, and regional inequality over time. There is also a phenomenon called mortgage lock-in, which has become increasingly significant in recent years, where a homeowner who locked in a low mortgage rate cannot afford to sell and buy a new home at a higher rate without massively increasing their monthly payment. The result is that millions of homeowners are effectively frozen in place by the economics of their own mortgage, unable to move, unable to downsize, unable to chase opportunity, not because they cannot afford to move financially, but because the structure of their housing debt makes it irrational to do so. And there is a concentrated catastrophic risk embedded in homeownership that the investment industry would never allow in any other context. When you own a home, you are making a single concentrated bet on one specific piece of land in one specific local market, a bet with no diversification whatsoever. If the major employer in your city closes, if the school district declines, if municipal services deteriorate, if a new highway gets built next to your house or a new industrial facility opens nearby, your asset can lose 20 to 40% of its value in a few years with no recourse and no hedge. The post-2008 housing collapse in inland California and Arizona, and the long multi-decade decline of property values in areas like suburban Detroit, are documented examples of residential real estate delivering exactly that kind of catastrophic localized loss, the kind of loss that a diversified equity portfolio would never produce from a single holding. Now, none of this means homeownership is always wrong, but the question is never whether homeownership can work. It is whether the cultural framing of it as universally the smartest financial move is accurate. The homeownership narrative is, at its core, a policy product, built and maintained by a specific coalition of interests. The mortgage interest deduction, the capital gains exemption on primary residence sales, the structural undertaxation of imputed rent, and decades of federal housing finance policy all channel resources toward homeowners rather than renters, not because the economics demand it, but because a nation of homeowners is a nation with a structural political incentive to defend asset prices. The mortgage interest deduction itself is regressive. It benefits high-income homeowners who have larger mortgages most heavily, while providing minimal benefit to lower-income homeowners and nothing at all to renters. There is a quiet transfer happening continuously from renters, who own no asset and receive no subsidy, to homeowners, who do, and beyond homeowners to the banking sector, which collects the largest direct fee from the entire transaction. bought at a reasonable price in a growing region, held for a long period with fixed-rate financing, maintained within budget, and treated primarily as a place to live rather than as an investment vehicle. Homeownership can be a rational decision that builds equity over time, but the cultural pressure to buy at almost any price, in almost any market, at almost any stage of life, because owning is always better than renting, that pressure is not financial advice. It is wealth stationing disguised as wisdom, and the people who design the system are not the ones paying for it. If this changed the way you are thinking about the biggest financial decision most people ever make, there is another video that breaks down a different wealth myth with the same level of detail. One that almost everyone believes and almost nobody has actually checked the numbers on.